Hi viewers, today in our Centricity Speaks episode, we have with us Rohit Beri, Fund Manager True Beacon. True Beacon is a sister company of Zerodha, one of the leading broking houses in the country. Hi Rohit.
Hello Vinay, thanks for having me.
So we are here to discuss one of the strategies which is equity factor quant. It's a quite a different, non-traditional, non-conventional strategy. So Rohit, considering it's a machine learning quant driven strategy, how will you differentiate it from a traditional long only equity strategy?
Thank you very much. That's a very good question. So there are two differences. First of all, it's a quantitative strategy, which means it's not me as a human being, me as a fund manager manually picking the stocks. The information about a stock is translated into mathematical scores across variety of factors. And then there is a math model behind it, which is determining across 200 stocks, which we look at, Nifty 200 as our universe, to figure out which stocks on a relative scale are better to be held. That is one thing. Math is the center of everything. Second aspect is shorter duration of holding. Our average holding period is about 3 months. Compared to a traditional long-only strategy where holding period may range in years, our holding period is in months.
So what is the relative average duration of the stocks that you hold in the portfolio?
2.5 to 3 months. About 90% stocks are held for more than a month. About slightly close to 10% of the stocks are churned in and out within a month itself.
Okay. So just going back, can you just dive down back into the investment philosophy? I just have gone through the strategy. I think there are 4 anchors behind the strategy.
Yeah. So there are 4 anchors. Fundamental analysis does not mean I'm doing bottoms up fundamental analysis. It effectively means I'm looking at the same information which a traditional bottoms up investor is looking at. So the signal universe is fundamental universe. There is a role of price action about 20%, but 80% of the weightage is given to fundamental factors. Second pillar is quantitative finance. As I earlier hinted, it's a math-driven model, stock picking. Third pillar is data science, and this is where we are unique, at least so far in India in long-only space. Our toolkit relies squarely in the world of machine learning and artificial intelligence. We do not use traditional econometrics or time series-based models to pick stocks. We use modern machine learning tools. There's a lot more informational advantage of using that. Obviously, it comes with a lot of challenges which you have to deal with. And the final pillar is behavioral psychology. There are 2 aspects of our research. One is causal inference, figuring out cause and effect relationships before we trade something. And that puts us in we make use of understanding human behavior and how it impacts asset prices to understand how to trade stocks. So these 4 pillars put together forms the backbone of our product.
Quite interesting. So Rohit, one of the main I think long only equity fund managers looks for is fundamental analysis. So you mentioned specifically that 80% of your data input comes from fundamental analysis, which is at the same parameters which any long equity fund manager looks.
Yes.
The second thing is quantitative finance. So I mean, just to deep down, once you have put in the parameters onto the fundamental analysis, how the next step of quantitative financing comes into the picture?
Yeah, so see, quantitative finance is more philosophical part. What comes into the picture is the data science approach, rather than a traditional quant-fin approach. By quant-fin, what I mean is, listen, if I'm trying to judge quality of management, it's a very abstract concept, but I need to translate that abstract concept into a number before I feed it into my model. So the first part is taking these abstract concept measures of quality. Now, you can have ROA as a measure of quality, but if you want to say management guidance, consistency of management guidance, it's very difficult to quantify, and that's where our skill set lies, to quantify these abstract concepts into numbers so that we can then use mathematical models to analyze them. So it's quant-fin is more philosophy and the process-oriented research, and then the toolkit is machine learning and data science.
So the next thing I think that our viewers would be very keen to know is how data science, because data science is the next big thing, everybody is talking about it. but how this as a function, as a tool can come into the strategy and play a bigger role.
Yeah. So see, ChatGPT first of all have suddenly brought artificial intelligence and machine learning to forefront of conversations in our everyday life. However, what people don't know that data science, artificial intelligence, machine learning has been used in finance for a very long time. Credit card fraud detection. You make a major purchase on credit card, or you make a big UPI transaction, you get a call from the bank. That is happening because of AI, ML working at the back, data science working at the back, and they are like, okay, something is unusual, let me call him. Call the client and check if this is a correct transaction. Fraud detection, credit scoring, and algorithmic trading. Algorithmic trading has been using artificial intelligence, machine learning, data science for almost a decade now. Where data science has not made its foray massively, particularly in Asia and in India, is stock picking. There is a very good reason why you should use it, and one very good reason why people aren't using it. Good reason to use it is that for given signal, the amount of information which you can extract from AI ML tools is a lot more than your traditional econometrics based models. ML models are non-linear in nature, so they are able to extract non-linear information. Traditional models are linear in nature, so there is a limit to how much information you can extract. Secondly, ML models are also able to help you reduce the noise in the signal. Traditionally, financial time series is extremely noisy, so signal to noise ratio is really, really bad, and ML can help in reducing, getting rid of that noise. So there is very good reasons why you should be using it. The problem is ML requires massive amount of data. But if you look at from an investing perspective, and if your horizon is even as short as a month, you don't have a lot of data. Like if you look at Nifty 200 universe, which is about 200 stocks today, but about 400 stocks over the life, and about 12 years of data. And on a monthly basis, it's only 120 data points across 400 stocks, which is not a lot of data at all to train these models. So they tend to overfit. So you need to have very deep understanding of the domain and data science processes to ensure your models don't suffer from these problems. And that requires huge amount of talent at your disposal, which is very scarce to come by. So that's why if you see Asia kind of have not adopted these technologies, whereas US and Europe, particularly New York, London, Bay Area is way ahead in the process. But I think in that sense, we are leaders in Indian markets in adopting data science for long-only investing.
Perfect. So one of the last parameters which I believe is one of the main factors how equity markets or capital markets behave is behavioral psychology of the investors. And we have seen that, whenever there is a trade happening in the market, so there is a buyer, there is a seller, so both have different approaches to a single stock. How behavioral psychology is playing into the, it's playing into the market, but how you are taking advantage of behavioral psychology into the strategy?
Yeah, so see, humans behave differently in different environments. We all know in a bull market, people suffer from FOMO. In bear markets, there is panic. And in sideways market, there is aloofness, disregard for the market, disinterest, right? Ex ante, it's very difficult to monitor these. But when you use machines are able to see telltale signs of what investor behavior is, how they are behaving, because they are able to analyze vast swaths of data, whereas human minds suffer from cognitive limitations. Too much information, we are unable to decide. We need narrow set of important points to make a decision. Machine can look at this broad set of data points, collate them together, narrow them down and say, what is the right decision to make? So our entire research, we say, is focused on causal inference, cause and effect relationships. And therein, behavioral psychology, human behavior, biases, cognitive limitations play a major role, because what we are trying to do is, in the data science, is to understand what are the telltale signs of human behavior and how they impact the markets, how they impact the asset prices. Because that is the cause and effect relationship which is generating inefficiency in the market and is cause of our alpha generation. If there is no inefficiency, we cannot make alpha. So we want markets to be inefficient. but we want to understand how that inefficiency plays out and how it gets corrected. So behavioral psychology is basically our mainstay why we make money.
So do you believe that Indian markets or emerging economies are still inefficient in terms of or relative to developed economies like US and Europe? Do you believe that this inefficiency can be a roadblock or can be a hindrance to the strategy?
Good question. So I will say Indian markets are, compared to global markets, are they inefficient? In pockets, yes. But India is reasonably sophisticated market. NSE is the largest trading venue for options in the world. $1.8 trillion worth of options are being traded on a daily basis. So is that market inefficient? No. Compared to our developed peers, no. But there are inefficiencies in the market. We want markets to be inefficient. Alpha is only generated by taking advantage of those inefficiencies. But then the trade-off, liquidity versus inefficiency. More liquid markets get, more efficient they get. Our product ideally wants highly liquid, highly inefficient markets so that we can trade a lot and take advantage of all the inefficiency. Unfortunately, these things, as markets become liquid, they become more efficient. So you need to keep becoming more and more sophisticated to extract that tiny bit of inefficiency, but you have liquidity on your side. Indian markets, I should say, there are inefficiencies like liquidity only stems in top 200 stocks. Okay, beyond that, you don't have much liquidity. So there is reasonable amount of inefficiency there for us to exploit and reasonable amount of liquidity there for us to exploit. My ideal wish will be, if markets become more efficient, I'm happy with it. I want more liquidity because I can trade more and I can extract more out of it.
Okay. So how do you see that? I mean, you look at Nifty 200. So your benchmark is Nifty 200, and how often you rebalance the portfolio, or what are the bases on which the portfolio is rebalanced, and what is the average average daily routine of a fund manager in managing this strategy?
Yeah. So see, it's a relative value trade where every day we run our model. Every morning we run our model, we look at how the signals have changed.
Signals, you mean fundamental signals?
Fundamental signal, basically our model signals. Finally, what our model is outputting. So our model basically categorizes stocks into different categories. Top categories buy, next category is hold. Then we have different kind of B categories, let's say sell category 1 to sell category 8. Every day we run our model, we look at what we hold and what our model is saying we should be holding.
Okay.
We compare the two and we run an optimization algorithm which tries to balance the alpha we can generate by rebalancing, but the cost of rebalancing in terms of securities transaction tax, price impact, and tax impact. So we try and balance this, saying how we can maximize. So on an average, we do about 2 to 2.5% of portfolio churn every day. So it's a very high churn strategy, but the churn is driven again by a model which is trying to maximize the alpha net of costs.
Okay. So considering it's a high churn strategy and you churn 2.5% on a daily basis, so I believe the overall annual turnover will be 4x, 5x.
5 to 6x.
5 to 6x. So looking at that and the cost and the impact cost, everything including, what is the investors can expect in terms of alpha over Nifty 200, let's say?
So our expectation is, if investor is invested over 3 to 5 year period, Nifty, our index should largely give somewhere between 12 to 13% returns. And as a strategy, after fees, we are targeting at least 6% alpha over the market returns. So if market is giving 12 plus, we are confident that we'll be able to generate 18 plus for our investors. Keep in mind, we will have good periods, bad periods. So it is 3 to 5 year guidance, not necessarily 3 to 5 month guidance.
Okay, although it's a high churn portfolio, but you still believe that the investors should be investing into this strategy with at least a 3-year time horizon.
At least a 3-year time horizon. So our model estimates, we have only been running it for 1 year and we have cumulative alpha after fees of upwards of 8% as of now in 11 months. But our model estimates that if you hold this strategy for about 3 years, there's an 80% chance that post fees you're sitting on a reasonable alpha pot. Year 4 and 5, you're almost certain that you are sitting on a very large alpha pot. But if you're only invested in a year 1 or 2, the probabilities of you being underwater in alpha terms is about 30%. So time is our friend because we churn. It's like tossing a coin. If you toss it 5 times, let's say coin is biased coin, which comes head 60% of the time. But if you toss it 5 times, you can have 5 tails.
Yeah, absolutely.
But if you toss it 1,000 times, it's going to be very close to 600, 400. Not exactly, never exactly there, but very close there. So you need time at your hand for the strategy to play out. It is a strategy which, even if it has an underperformance for a period, it won't be very significant because the strategy works on margin of safety concept. It's a mean reversion based strategy. So our drawdowns on alpha terms are reasonably well contained, but there can be a period where we have that, and we need to have enough shots
to play
to give you that outperformance which we are looking at.
So this brings me to the question, which is, how we have seen COVID, we have seen a lot of times when the markets behave quite irrationally, investors behave quite irrationally. So do you believe there is, in case of any black swan event or in case of sharp drawdowns, how will the strategy behave in that case, or what could be the impact on the strategy?
Yes, so very good question. See, it's a long only strategy. Beta is beta. So if market first to fall suddenly in a black swan event by 40%, I will fall along with the market. And because that fall is very steep in a very short period of time, the alpha I'm generating will not necessarily compensate that fall. If markets were to fall 40%, our estimate is we can be anywhere between negative 35 to negative 45 with an expected alpha of only 2% over that month. But we can be anywhere. But if markets were to fall 40% over a year, it's a different scenario. Our expected return in that scenario is somewhere between negative 25 to negative 28. So our model is able to take advantage of a prolonged fall and generate alpha, so it is lowering your drawdown over a period of time. But if it is a sudden knee-jerk fall, model is not capable of saying, listen, because it's not a long short model. I cannot suddenly say, listen, go cash. We don't take cash calls, and we cannot short. So model is not designed to do that. So if there is a black swan event which falls suddenly, you will fall along with the market. But then, typically there is a big bounce back after a black swan event. It's not a long short model where you have lost your capital. Your capital has come back, but if you're still invested, you will bounce back usually much faster than the market.
So to crisp, if the market goes suddenly down in a couple of market sessions, then the strategy might not be able to capture or might not be able to sustain the downside. But in case there is a prolonged, drawdown phase, then the strategy will definitely outperform the benchmark.
Yes.
So any specific views on how the Indian markets are behaving and how this strategy is positioned, looking at the current equity market scenario, or you believe that irrespective of the current equity market scenario, we are at all-time highs, the strategy won't behave any differently?
So we generate most of our alpha on bad days.
Okay.
So we make 7 basis points on an average alpha. This is our realized alpha over the last 11 months, and only about a basis points of alpha on the up move. So if you're a long-term investor, and if I'm giving you 7 basis points every time market goes down, I'm saving you 7 basis points. And I'm also giving you a slight bit of alpha, market goes up. Market is going to give you 12% over a long period of time. But if I can keep generating this alpha for you, 5 years down the line, you're not going to complain where the market is. Yes, market is an all-time high, but from a couple of years, earning multiples have corrected significantly. I am per se bullish on the market, but if you were to ask me at this stage, can markets correct 5 to 10% over from here? Absolutely. I tell people, listen, my job is to predict which stocks are going to do better. I think trying to predict where market is going is a futile exercise. There are obviously geniuses who can. I'm not one of them. And COVID is a classic example. Globally, we suffered from the world's biggest economic and health crisis, and the markets everywhere reached an all-time high, the biggest rally we ever saw. So trying to predict that, if you're concerned about the market, I tell people, listen, even in a strategy like us, while there is a minimum starting point, you can always spread your cash over a period of time, so that timing issue does not hit you. That's why SIPs, people in SIPs are minting wealth more than anybody else, because they are like, listen, I don't know how timing works. Why spend time something which is almost unsolvable?
So this is on the PMS platform.
Yes.
Just to make sure our viewers know, and the minimum investment amount remains 1 CR.
The minimum investment amount is 1 CR. It's higher than traditional 50 lakhs. The reason is, we start with about 23 stocks, but on an average, we are holding about 40 stocks in the portfolio. So if we have lower amount of capital, the rebalancing becomes very highly inefficient. So to not lose money for inefficiency, the starting amount is 1
And
CR.
people can top up in multiples of?
People can top up in multiples of 10 lakhs.
Okay. So thank you Rohit. So guys, someone who is looking for a non-conventional, non-traditional long-only equity strategy, this strategy is worth looking at, because you are giving money to a fund manager who has more than 2 decades of experience, who has worked on quant-based strategies in the past. And this strategy, over a 3-year, 5-year time horizon gives you a, they are expecting to generate an alpha of roughly 5 to 6% over a Nifty 200 benchmark, which remains, I would say, which is a remarkable number if they can achieve that. So I think this strategy, and looking at how the markets are behaving, there are multiple long only equity strategies. There are more than 200, 400 PMS managers in the country which are only long only. So someone who has a decent portfolio size, who has a lot of long only equity strategies, this type of a different strategy, definitely makes a place into your portfolio. Thank you Rohit.
Thank you for having me.